Small business tax. 5 proven ways to legally reduce it. Here is a quick deep dive into fiscal tips and tactics that small businesses can adopt to comply with federal and state tax regulations while lowering their fiscal debt, and a great resource for the entrepreneur or small business owner, no matter the legal structure of the company: sole proprietor, LLC, partnership, LLP, S corporation, or C corporation. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about small business taxes and 5 proven ways to legally reduce them. Number 1, know the various types of business taxes. Before you are even thinking about reducing your taxes, you need to know what kind of taxes you as a small business owner might have to face or pay. There are a variety of taxes for businesses. Now, income taxes. So these are federal and in most cases state income taxes to contend with. Whether the business pays the tax, as in the case of a business organized as a C corporation, or the owner pays the tax on his or her share of business income and expenses, as is in the case of a business organized as a sole proprietorship, partnership, limited liability company LLC, or S corp. This is what experts called a pass-through entity. So when an entity does not pay taxes on its income at the entity level, but pays the income tax at the owner's level, you call it a pass-through entity. So a pass-through entity is a sole proprietorship, for instance, a partnership, LLC, or S corporation. Besides income tax, we have employment taxes. So if you have employees, you must withhold income taxes and the employee's share of Social Security and Medicare taxes. Those are called FICA taxes. You must also pay the employer share of FICA, plus state and federal unemployment tax. Now, if your business is incorporated, you are an employee if you work for the business, and you owe these taxes even if you are the only employee. If you are self-employed, you owe self-employment taxes, the equivalent of the employee plus the employer's share of FICA on your net earnings from the business. Number 3, sales taxes. Now, if you sell goods and services and you are based in a state with a sales tax, you may be required to collect those sales taxes on your transactions. While the customers pay the sales taxes, you can be subject to penalties, and very heavy one at that, if you don't collect the taxes and pay them to the states. The 4th category is excise taxes. Now, depending on the type of business you operate, certain business may pay excise taxes on fuels, highway usages by trucks, and for other activities. All right, so the 4 main types of business taxes: income taxes, employment taxes, sales taxes, and excise taxes. Number 2, take the right deductions. If your goal is to legally reduce your taxes at the state and federal level, you need to understand what's really going on. And to take the right deductions, you need to have an impeccable bookkeeping process. You need to set up books and records properly. Now, even though you may use a casual approach to record keeping for your personal taxes, you can't do this for a business, right? Because the tax law, the Internal Revenue Code, specifically requires certain records in order to take deductions. So if you're trying to claim certain deductions on your tax return, you better have some you better substantiate it. I'll get it. You better prove it. You better substantiate those deductions. So you need to have some evidential matter, what accountants call evidential matter. So without those records, legitimate expenditures may not be deductible. Now, you need to comply with the tax rules with the IRC, the Internal Revenue Code. You need to have a system to track your income and expenses. That system can be manual or electronic. Manual in the sense that you have an Excel spreadsheets and you sort of combine journal entries in that Excel spreadsheet, plus a record keeping. You have the paperwork somewhere in your closet. That's the manual, and then you have the electronic one. Now, nowadays, most small business owners will rather use the electronic ones. The electronic ones can come either in the form of software that you pay for on the internet, or software that you buy, and you buy the license actually, right? So you can have a software, or an app rather. You can have an app from your phone and do everything from your phone, right? So a system to track your income and expenses, if you choose the electronic version, it's pretty easy. This is computer-based record keeping solutions that enable you to handle this matter yourself. You also need to have procedures to collect and store required receipts and other proof of expenditures. So you want to set up file systems to categorize your receipts, right? So if this is meals and entertainment, if the cost relates to car and transportation, if the expense relates to payroll or capital expenditures. Now, capital expenditures apply to any asset that you buy for the company and that you will use for more than 12 months. That's the key word when it comes to labeling an asset capital or non-capital. So a capital asset is a long-term asset. And when you buy a capital asset, you say that you incur a capital expenditure, right? So things like machinery, equipment, cars, those will go under the category of capital expenditures. You also need to comply with tax rules when it comes to policies on certain record keeping. For example, if you use your personal vehicle for business, you need to track your business mileage in a diary or logbook. If you have employees and reimburse them for their business related car expense, you want to explain to them how records must be kept. If, for instance, you're using your basement as home office, you need to have a clear policy, a clear pattern, a clear paradigm when it comes to record keeping. Otherwise, the IRS will just slap you with a very huge fine. And nobody wants that, right? I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the awesome Sweetie Kiwi Show. I'm talking to you about 5 proven ways to legally reduce small business taxes. I've already given you 2 ways. Let's go to number 3. Make appropriate tax elections. Now, before I get into the nitty-gritty here, I want you to just go ahead and smash that like button for us. Comment below, let us know your experience with the taxes as a small business owner or an entrepreneur. I want you to really click on that subscribe button if you haven't already done so, and turn on the notification bell so you are informed in real time whenever we drop a new show. And we do this every single day, rain or shine. Comment below, share a like. Number 3, make appropriate tax elections. Now, under the tax law, most expenses that you incur in a business are deductible, right? Now, most income is taxable, of course. Now, the tax law, the IRC, the Internal Revenue Code, gives you, as a small business owner, options on when and what to do when it comes to certain deductions and income. Let me just give you an example. The cost of buying business equipment usually is deducted by claiming a depreciation allowance fixed by law over 5 or 7 years, depending upon the machinery, or longer periods. However, under certain conditions, you may qualify to elect first year expensing to deduct the entire cost of equipment in the year it is placed in service. This is called Section 179. Now, Section 179 allows entrepreneurs to deduct the entire cost, especially if they want, and this is a tax strategy. If you want to reduce your income from the first year in your income and also your income tax, you can elect for that. Now, making this elections accelerates the deduction, giving you an immediate tax benefit for your outlay. Think about it, because usually the way it works is that, let's say you buy a car or you buy machinery. The machinery costs $100,000. because this is a capital asset, it is considered for tax purposes a capital expenditure, right? Now, machinery can be depreciated over 5 years. So that means that you'll have to, instead of reducing your income by 100,000, you have to reduce it only by 20,000 for the first year, which means you have 80,000 more on which you have to pay taxes, even though you have spent $100,000. You have paid the supplier 100,000 to basically pay for the machine, right? What the IRS is saying is allowing you to do under Section 179 is to claim to deduct $100,000 as opposed to 20 grand. And by doing that, your net income is going down because your expenses is going up. Your expenses are going up, and if your income is going down, your taxable income is also going down, which means your tax in fine is also going down. Now, the expenses of a personal car or truck used for business can be deducted in one or two ways. You can claim actual cost or relying on an IRS standard mileage rate. If you keep good records of your cost, you can then choose the deduction method that produces the greater write-off. Selling property on the installment basis, where at least one payment will be received in the year after the sale, generally means that the gain will be spread over the period in which the installments will be received. However, you can also elect to report the full gain in the year of sale, even though payments won't be received until later. So this election makes sense when you have current losses that can be offset by the installment sale gain, meaning that the gain is fully sheltered from tax, right? So I'm just giving you folks here a few appropriate tax elections that you need to make to reduce your fiscal debts legally. Let's go to number 4. Stay updated on current tax legislation. It is very important. If your goal is to basically reduce your taxes, you need to stay on top of the legislation, right? That law, the tax law, is constantly changing, with major legislation, court cases, and IRS rulings appearing frequently throughout the year, because the IRS rulings also impact tax laws. Now, many of these changes present positive tax opportunities if you know they exist and you act on time, right? So sometimes waiting until the annual meeting with your accountant may be too late to learn about and act on those opportunities. One thing we advise a lot of small business owners to do is to go to Google and to type certain keywords and to place alerts on those keywords. You can type like, tax changes or tax law changes, whatever. You just pick 9, 10, 12, 15, or 20 keywords that are related to small business tax and place those alerts in Google. So whenever something happens, Google will send you an email. That way you are staying on top. Another way to stay on top of the tax legislation is to read. Go on the IRS website, and you go to the section updates or the latest, and you can see all the rulings, all the headlines, all the key information that you need to be aware of. For example, Congress just passed a few weeks ago. We are currently in the Corona phase. For those who are listening to us now, or 5 years from now, or 10 years from now, we are currently in the coronavirus period. So Congress passed a few weeks ago the Coronavirus Relief and Economic Security Act. This is called the CARES Act, right? So you got to be aware of that. For you to reduce your your fiscal debt, you need to be aware of that. This is one major piece of information that you got to be aware of. Similarly, in 2008, when we had the banking crisis, Congress passed a measure as part of the Economic Stimulus Act of 2008, and this let businesses deduct the full price of qualifying equipment purchased or financed during that tax year, right? So you have that. Now, remember that this is not the only time. The Congress always does this. Another example, in 2005, when we had Hurricanes Katrina, Rita, and Wilma, right? A number of tax-saving breaks were created to run for a short time. The charitable contribution limitation was raised for individuals and corporations, but only through the end of 2005. What's my point? My point here is that sometimes, unfortunately, Congress will act when things are bad, when there is a crisis, when there is a lot of bad things going on. However, if you are a small business and you are smart and you stay on top of the legislation, you are currently updated. You can use this relief measures, this relief efforts, this relief guidelines to your benefits and reduce your legal and fiscal liability. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still having conversation here around 5 proven ways to legally reduce your tax, your small business tax. Now, let me give you those 5 ways. Here are common ways to save on taxes. You can take advantage of some standard tax rules that can save your business money. Contribute to a retirement plan. If your business is profitable, you can shelter income in a qualified retirement plan, and this will provide you with a tax deduction for your contribution. Deferred tax on earnings on contribution. Tax is ultimately paid when you start taking money from the plan, usually at retirement. And the good thing is, if you have staff, you can gain employee loyalty for providing them with a retirement savings opportunity. And if you want to know more about that, just go to the IRS website, www.irs.gov, and it is IRS publication 560. So everything I'm giving you here is legal. It's IRS approved. It's approved by governments, by the authorities. It's legit. Number 2, adopt an accountable plan. So if you have an employee and say you reimburse them for using their vehicles on company business, you want to foster an environment where those employees adopt an accountable plan to save them income taxes and save the company payroll taxes. So this scheme lets you reimburse an employee for business expenses without having to treat the reimbursement as income to them, right? So the result here is that the reimbursement are not included in the employee's W-2 form. The employees are not taxed on the reimbursement, and the company saves payroll taxes, I'm talking unemployment taxes, and FICA on this amount. Way number 3, defer income and accelerate deductions. Now, there are several ways you can take near the end of the year to put off income into the next tax year and increase your deductions in the current tax year. So let's say in the last month of the year, if your fiscal year starts January 1st, the last month of your fiscal year will be December. You can send your bills a few days later. So in the last month of the year, you send your bills out a few days later. That means getting paid a few days later in January of the next year and being able to defer the income, right? Instead of getting paid in December of the current year and having to declare that income immediately. Think about it. Similarly, one way to accelerate your deductions here is to see that what bills you have due in January and pay them before the end of December so that you can take that deduction during the current year. Number 4, structure your business the proper way. Now, when it comes to legally reducing your tax bills, you got to think about what kind of a legal structure you have for your business, right? Because a lot of, believe it or not, this is the single most overlooked aspect in tax planning. Most businesses that start out small, they don't change their structure of their businesses when they should. Let me give you an example. Say you have a closely held company in which the income passes through to you. So you have a pass-through entity. You are the owner. Those are usually set up as an LLC or an S corporation. I mean, I'm not saying there is anything wrong with those structures, but think about this. You are able to gain tax benefits by structuring your company as a C corporation in which the first $50,000 of your income is taxed as a rate of 15%, as opposed to a 35% if you are in the highest tax bracket. So this sort of a fiscal optimization, and this is legal, it's pretty good. It's pretty fantastic. Paying 15% versus 35%, you're saving 20%, and 20% of $50,000, that's 10 grand, and that's a lot. That's something. Number 5, Consider adding to employee benefits instead of raises. So a great way to save on taxes for you and your employees is to compensate them by increasing your contribution to their health insurance cost instead of giving them the same amount in terms of a salary increase. I'll give you an example. You as the employer could give everyone a $500 a month raise, but then the employee will have to pay income tax, FICA tax, and Medicare tax on those wages. You, the employer, will have to pay the employer's share of FICA, Medicare, and may have to pay federal and state unemployment taxes as well. Let's say the employer went to employees and said instead, rather than giving you guys a $500 more, the company is going to pay $500 more for your medical insurance. That's just fantastic because this eliminated the income tax, FICA, Medicare, and unemployment taxes. So the employer saves and the employee saves. You have here a win-win situation, folks. A win-win situation. All right. So this is it, folks. I'm going to wrap up today's conversation here. So I was talking to you about 5 proven ways to legally reduce small business taxes. Now, I structured this conversation around the fact that I explained to you the various types of business taxes. I advise you to take the right deduction, to make appropriate tax elections, to stay updated on current tax legislation. And here are the common ways to save on taxes. Contribute to a retirement plan. Adopt an accountable plan. Defer income and accelerate deductions. Structure your business the proper way. Consider adding to employee benefits instead of raises. All right, folks. I will be leaving for now. And before I actually go, just want to give you a quick pro tip. How to save on taxes. One of the things you need to ask yourself is if you don't have the right expertise in taxes, consider hiring a financial advisor or a tax planner or a tax lawyer. If you need help, go ahead, because the money you're paying to this person, to this professional, is way less than how much money you have to pay in taxes if you don't have the right strategy in place. Okay? I will see you next time. But until then, remember, stay marvelous.